Hey guys, and welcome to another video. Today we will be looking at Pepsi stock. Pepsi is a beverage company like Coca-Cola and provides beverages like Pepsi. You may have tried it before. They also provide different other beverages and are known for their Super Bowl ads, for example. So they do a lot of marketing too. Maybe even more than Coca-Cola. So it's a big company, but let's now look at the stock and evaluate if it's a good investment too. So first we will be looking at the graph of Pepsi, and as you can see it has gone down a bit from almost $200 to $161 in a few weeks from the start of from mid of 2023, around that area, May 2023, and that could mean it's at a discount, but we will see. Now let's start looking at the financials. So first we will look at the market cap. It has a market cap of $222 billion. Now let's look at the revenue. So their revenue has increased from $62 billion to $86 billion. And their quarterly revenue is also increasing. Is also still increasing. They have positive net income, which has also increased from $6 billion to almost $9 billion. Their outstanding shares have decreased a bit from 1.4 billion to 1.39 billion, which is good, but not that much of a decrease. Now let's look at their balance sheet. First, their cash flow statement. Their cash flow from operating activities has increased from 10.4 billion to 10.8 billion, which is really little, but their free cash flow has decreased from 7.3 billion to 5.6 billion, which isn't really nice. You don't want to see that. And I think their free cash flow is smaller than their net income, which is also not really nice. So that's a negative for the stock. Their total debt is at 41 billion and their net debt is at 36 billion, which would mean they need like 5 years to pay it off, or more with their cash flow being lower than their net income. 5 to 10 years to pay it off, so they have a middle amount of debt, let's say. Now let's evaluate the stock price and at which price it would be a good investment. And let's see if we can buy it right now. So first we enter the stock ticker, then the revenue of 86 billion, then the revenue growth of, in the lowest case, 3%. Profit margin would be the lowest, would be 7%, which is low but could be for a beverage company. Price to earnings of 15. I think even though we could go with a really low assumption of 10 in this case, because for me it's a 10, my personal opinion. I don't see it's too bad. I don't think Pepsi is that high of a PE company, but these are really low assumptions, and in this case we would buy at $16, which is 1/10 of the price right now. So now let's go with a more reasonable 15 compared to the current PE ratio of 28, and in this case 25 would be our buying price. We can see with 3% revenue growth our revenue would go to 115 billion. We could maybe go to 5% and increase our net margin to 10%. In this case we would have a buying price of $43 with this model. So in this case these are more reasonable assumptions. I wouldn't really go that much higher with the revenue growth. Maybe with the profit margin we could go to 12% and see. This would give us a buying price of $52. Or we could go with a higher price to earnings of 20. I wouldn't go higher than that with this stock, which would give us a buying price of almost $70. And let's go with the highest profit margin if they really do good. And maybe the profit margin would increase over the long term. Let's say 19% in this case was the highest. 19%, which would give us a buying price of $110. But these are really high assumptions, so I wouldn't recommend you to buy. I think with this model my buying price would be $70 to $50, so a lot lower than right now. But let's look at our cash flow valuation model now. We'll put in the ticker symbol, then we'll go to Yahoo Finance and look at the expected cash flow growth, which is 8%, 4% for the next few years after that, and the terminal value would be 10 for the lowest assumption. Then we would look at our free cash flow of 5 billion, 5.6 billion, and our stock-based compensation of 300 million, so that's a lot lower, 340 million. And our net cash debt ratio, our net debt is 36 billion, so we'll enter minus 36,000. And our shares outstanding, 1.4 billion. And in this case the stock would be overvalued and we should buy it at $17, which is surprising with this low amount of stock-based compensation to free cash flow. But let's put our terminal value at 15, and we will buy at $25 per share with these conditions. You could of course argue that the free cash flow is still a bit low. It's only around 10 billion, and we could go a bit higher with these assumptions. I wouldn't recommend that, but let's say we go with 10% and 5%, or maybe even 12% and 6%, which would make our free cash flow go to 14 billion, around that area, and we would get a buying price of $37 per share. So depending on which valuation model you use, it's a buy at $40 to $70, I would say, in this area. Maybe $30 to $70, depending on how which assumptions you think are reasonable. So if you enjoyed this video, give it a like, and bye.